the previous segments, we began a conversation by touching on two fundamental aspects of the tax planning rules, tax minimization and business structure in Canada. There has been significant pushback from the tax community and various other business groups when the changes were first proposed. The primary concerns that are tried and true prudent tax planning strategies were all attacked. It granted CRA overreaching new powers, making it virtually impossible to pass a business onto the next generation. This change disincentivized entrepreneurs to go into business and professional practices. Canadian business owners respond vigorously and measures were rescinded. But what's finally tabled challenges personal initiatives and its rewards for business and individuals and professional corporations, I should say. Today we're here with Wilmot George, tax specialist with CI Investments, and Trevor Perry, president of TRP Consulting. He's a tax lawyer at that company. Wilmot, what are the main concerns about all these changes?
David, this is the largest change to corporate taxation in decades. And some have suggested that the government should have taken some more time to do more extensive research and a more complete review. Others have suggested that the 75-day consultation period that the government gave to review these changes was not sufficient. And yet there are other Canadians who've suggested that the timing of the release of the proposals wasn't ideal. They were released during the summer, traditionally a period where many families and business owners are away and not fully engaged. And there's also the challenge that these proposed changes are quite complex. They are highly complex in that many tax practitioners, accountants, and lawyers have spent countless hours reviewing these proposals. So many business owners themselves are having a tough time understanding how these changes impact them.
And Trevor, you talk to a lot of business owners in your practice, and what are you hearing from them in terms of all these changes that are going on?
Anger. Primarily, that they've been the cornerstone of the Canadian economy, the employers of most workers in this country, and they have been characterized as tax cheats, not paying their fair share. They're also daunted by the complexity. And from a tax practitioner's perspective, the cornerstone of fairness of our system, which was integration, has been intentionally put off keel to the point now where the government would like you to take income, and lots of it, and tax it heavily. So the ability to use tried and true compensation and tax strategies that have been around since the introduction of the Canadian income tax system in 1971 are clearly under assault.
So given the complex nature of the new rules, what can and should professionals do today to basically reduce some of the impact of what these changes are that are coming down the pipe?
You know, the new rules, which for the most part take effect immediately, are complex, especially for busy business owners who don't spend a lot of time researching tax legislation. Knowing this, it's a good idea for owners of incorporated businesses, including professional corporations, to have a conversation with their financial and tax advisors to determine what the changes are and how they might be impacted. Now, because the changes take effect immediately, essentially, many current income splitting and passive investing strategies might not be efficient on a go-forward basis. Working with trusted advisors can help to assess impact and determine appropriate planning strategies going forward.
And Trevor, I guess there are, without any question, some legitimate ways that they can sort of buffer some of these tax changes.
Exactly. I mean, they haven't taken everything away. We have the ability to utilize a number of financial strategies and products to create long-term tax-efficient deferral. We have the ability to set up individual pension plans for incorporated professionals and entrepreneurs that will give them a material advantage in terms of saving for retirement with predictability and very robust tax relief. So they haven't taken everything away, but again, as Wilmot says, the key is to talk to your tax advisor. Tax planning is really an elaborate game of connecting the dots. You have to have somebody who can do that and also have an eye towards where you are in the life cycle of your business. Are you in profit maximization mode? Are we trying to continue to preserve deferral, or are we looking towards transitional issues and tax issues associated with the death of a shareholder? All of these are relevant.
Now, I do know that when you look at Canada in general, There are still roughly about 2,500 individual pension plans, which really are some of the tools that dentists and doctors and professionals would use.
Actually 13,000 of them.
Oh, it is? There 13,000 now? So we are seeing a big jump in the numbers of them. So some people are actually taking advantage of some of these things, I would assume.
Exactly. Indeed.
So I guess at the end of the day, what you really want to do is you want to sit down with your financial advisor and your tax strategist, ask them to show you the specific effects of these new rules, and suggest ways of reducing the impact of these new changes. There are still significant tax strategies out there for you to look at. Next, the government rules are going to be imposed, and some of them have already been imposed, and we're going to talk about some of those new rules with Trevor and Wilmot.